Lawrence Beckwith had a portrait of Warren Buffett in his study. Not a signed photograph or a framed magazine cover. An actual portrait, painted in oil by a local artist in Omaha, whom Lawrence had commissioned after his 5th consecutive year attending the Berkshire Hathaway annual meeting. The portrait hung above his desk, next to a framed Coca-Cola stock certificate from 1988 and a shelf that held every Berkshire annual report going back to 1977. Bound in leather and arranged chronologically. Lawrence was 58 years old and had built his entire financial life around the principles of the man in that portrait. He had read The Snowball 3 times. He had memorized passages from the letters to shareholders the way other men memorized scripture. He had named his golden retriever Munger. When his son asked him, at age 14, why they drove a 10-year-old Honda instead of a new BMW like his friend's parents, Lawrence had sat him down and explained the concept of deferred gratification with the same solemnity most fathers reserve for the birds and the bees. He had done everything right. He had bought wonderful companies at fair prices. He had avoided the frenzies and the fads and the initial public offerings that Buffett himself had called, with characteristic bluntness, a game of passing the razor blade from one hand to another, while everyone pretends they will not get cut. And now, at 58, sitting in that study with the portrait looking down at him like a silent judge, Lawrence Beckwith was staring at his brokerage account and seriously considering doing something that every fiber of his investing philosophy told him was a mistake. He was considering buying shares in the SpaceX initial public offering. The SpaceX IPO had not been announced yet. The S-1 had not been filed. There was no date on the calendar and no price range in the headlines, but the rumors had been building for months, fed by secondary market activity and stray comments from institutional investors, and the kind of breathless speculation that Lawrence normally ignored with the practiced contempt of a man who had lived through the dot-com bubble, the housing bubble, the SPAC mania, and every other chapter in the long history of people, convincing themselves that this time was different. Lawrence had ignored them all. He had held his Coca-Cola and his American Express and his index funds and his municipal bonds, and he had slept soundly through every correction and every crash and every panic, because he knew what he owned, and he knew why he owned it, and he knew that the man in the portrait would have done the same thing. But this time was different, and Lawrence could not figure out whether that sentence was the most dangerous 4 words in the English language, as Buffett himself had warned, or whether it was, for once, actually true. The problem was not that Lawrence had suddenly abandoned his principles. The problem was that his principles were in conflict with each other, and the conflict had been building for years, and the SpaceX IPO had simply brought it to the surface in a way he could no longer ignore. He believed in moats. He believed in buying companies with durable competitive advantages that could not be easily replicated. He believed in management teams that were owner-oriented and brutally competent. He believed in businesses that generated high returns on capital without needing excessive leverage. He believed in all of these things because Buffett had taught him to believe in them, and Buffett had been right about them for more than 6 decades. But SpaceX, by any honest assessment, had a moat that would have made Buffett salivate if it had been attached to a company that sold insurance or consumer products instead of rockets. SpaceX had a cost advantage in the launch market that was measured in orders of magnitude, not percentage points. SpaceX had a satellite internet business that was vertically integrated in a way that no competitor could replicate without spending decades and tens of billions of dollars. SpaceX had a founder who reinvested every available dollar back into the business with an intensity that bordered on pathological. These were Buffett criteria. These were exactly the things that Lawrence had been trained to look for. And yet, the mere mention of the words initial public offering was supposed to override all of them, as if the mechanism by which shares were first sold to the public was more important than the underlying quality of the business itself. That had never made sense to Lawrence, not entirely, and the SpaceX IPO had forced him to finally admit it. Let me tell you who I am before we go any further, because what I am about to say is going to make some people uncomfortable, and I need you to know that I am not saying it from a position of certainty or authority or any of the other things that financial media personalities project when they want you to trust them. I am not a financial advisor. I am not a Buffett scholar. I am not a value investing guru or a hedge fund manager or anyone whose investment decisions should be emulated without question. I am someone who has spent a very long time trying to reconcile 2 things that appear to be irreconcilable. The first is that Warren Buffett is the greatest investor who has ever lived, and his principles are sound, and the people who have followed them have, on average, done far better than the people who have not. The second is that Warren Buffett has been wrong about technology companies for most of his career, and the cost of his wrongness has been measured in hundreds of billions of dollars of foregone gains. And the people who ignored his advice about technology companies have, in several notable cases, become spectacularly wealthy. These two things are both true. They cannot both be dismissed. And the tension between them is the tension that every serious investor should be feeling right now as the SpaceX IPO approaches, because SpaceX is, simultaneously, the kind of business that Buffett's principles tell you to buy, and the kind of event that Buffett's principles tell you to avoid. And the resolution of that paradox is not obvious. It requires thinking through each of the components individually, and it requires a willingness to admit that even the greatest investor in history might have had a blind spot that is relevant to the decision in front of you. The first thing we have to do, before we can even begin to think about whether the SpaceX IPO is a good investment, is understand exactly what Warren Buffett has said about initial public offerings and why he has said it. Because if you are going to violate a principle, you should at least understand the principle well enough to know what you are violating. Most people who invoke Buffett's name in investment arguments have never actually read what he wrote about IPOs, and the people who have read it often stop at the headline without absorbing the reasoning underneath it. So let me lay out the Buffett case against IPOs in his own words, or as close to his own words as I can get, without quoting from copyrighted material, and then let me explain the reasoning that supports that case, because the reasoning matters more than the conclusion. If you understand the reasoning, you can apply it to any specific situation and decide for yourself whether the conclusion follows. If you only memorize the conclusion, you are not thinking, you are following. And Buffett himself would be the first to tell you that following anyone without thinking is a mistake. Buffett's stated position on IPOs has been remarkably consistent across more than 50 years of shareholder letters, interviews, and public appearances. He does not buy them. He has said, repeatedly and on the record, that he cannot recall ever having purchased shares in an initial public offering. He has described the IPO market as a game in which the sellers control the timing, the pricing, and the information environment, and in which the buyers are essentially playing poker against an opponent who gets to see their cards before they place their bets. He has pointed out that a company going public is, by definition, selling shares to you rather than buying them from you, and that the party initiating the transaction almost always has a better understanding of the value of what is being sold than the party receiving it. He has noted that IPOs tend to come in waves, that the waves tend to coincide with periods of market euphoria, and that the companies brought public during those periods are disproportionately the ones that make the most attractive narratives and the least attractive financials. He has observed that the underwriting process is designed to create a sense of scarcity and urgency that benefits the sellers and the intermediaries at the expense of the buyers. And he has concluded, after 6 decades of watching the IPO market operate, that the best strategy for the individual investor is simply to ignore it entirely. Wait for the company to prove itself in the public markets. Wait for the lockup period to expire and the insider selling to subside. Wait for a quarter or two of post-IPO financial reporting, so you can actually evaluate the business on its merits rather than its roadshow presentation. Wait until the excitement has faded and the stock has become boring and the price reflects something other than the fever dream of the offering week. If the business is truly wonderful, it will still be wonderful in a year, and you can buy it then at a price that is likely to be lower and almost certainly not as inflated by the hype. This reasoning is sound. It is not just sound. It is elegant. It is the application of a general principle, specifically that you should never buy something from a seller who knows more about it than you do, to the specific context of initial public offerings, and it has been validated repeatedly by the data. The academic literature on IPO performance is extensive and depressingly consistent. The average IPO underperforms the market over the 3 to 5 years following its offering. The IPOs that attract the most media attention and the highest first-day pops tend to be the ones that underperform the most. The retail investors who buy on the first day and hold through the lockup expiration tend to experience negative returns over the subsequent 12 to 18 months. The pattern is robust across decades, across markets, across sectors. Buffett was not just being folksy when he said to avoid IPOs. He was summarizing, in his characteristic plain English, a body of evidence that has been confirmed by financial economists at every major university in the world. The IPO market is designed to transfer wealth from public investors to private insiders, and it performs that function with remarkable and dispiriting efficiency. So if that is true, and I believe it is true, Why are we even having this conversation? Why is Lawrence Beckwith sitting in his study, underneath a portrait of the man who taught him everything he knows about investing, seriously considering doing the one thing that the man in the portrait has told him never to do? The answer, I think, is that Lawrence has started to notice something about Buffett's record that the hagiographers tend to gloss over. And it is the thing that every serious student of Buffett eventually has to confront if they want to be honest about the limits of his philosophy. Warren Buffett has made two kinds of mistakes in his career, and the distinction between them is the key to understanding whether the SpaceX IPO is one of them. The first kind of mistake is the kind Buffett talks about openly. He bought Dexter Shoe, a terrible business that was destroyed by foreign competition. He bought a stake in Us Air, which nearly went bankrupt. He bought ConocoPhillips at the top of the oil cycle. These are errors of analysis, errors that he made within the framework of his own principles. He misjudged a moat. He misjudged a management team. He misjudged the cyclicality of a commodity business. He has owned these mistakes candidly and learned from them, and they are part of why his later record is even better than his early record. The learning curve is visible, and it is inspiring. The second kind of mistake is the kind Buffett rarely discusses, and it is not an error of analysis within his framework. It is an error of the framework itself. It is the mistake he made when he looked at Amazon in the late 1990s and concluded that it was a retailer with no moat. It is the mistake he made when he looked at Google in 2004 and concluded that he could not predict its future cash flows with sufficient confidence. It is the mistake he made when he looked at Apple before 2016 and concluded that it was a technology hardware company subject to the brutal cyclicality that had destroyed every technology hardware company before it. These are not errors of execution. These are errors of perception. Buffett looked at these businesses through a lens that had been calibrated for an earlier era of American capitalism, an era of railroads and insurance companies and consumer brands and banks. The lens worked brilliantly for those businesses. It identified durable competitive advantages that were hiding in plain sight. It valued them accurately. It generated returns that compounded at 20% a year for more than half a century. But the lens had a blind spot, and the blind spot was in the part of the spectrum where companies were building new markets rather than competing in existing ones, where the moat was being constructed in real time from the materials of network effects and data advantages and learning curves, rather than from brand recognition and distribution, infrastructure, and regulatory capture. The old moats were visible through the lens. The new moats were not. And Buffett, for most of his career, did not buy what he could not see. The cost of this blind spot is calculable, and the calculation is almost too large to be meaningful. Berkshire Hathaway did not buy Amazon at any price before 2019, by which time the stock had compounded at roughly 36% annually for 22 years. Had Berkshire purchased a $5 billion stake in Amazon at the time of its IPO in 1997 and held it through the present, that stake would be worth approximately $170 billion. Compare that to the returns Berkshire actually earned on its capital over the same period, which were extraordinary by any normal standard, and you begin to see the shape of the thing that Lawrence was grappling with. The Buffett framework saved him from the dot-com bust. It saved him from Pets.com and Webvan and eToys and every other narrative-driven catastrophe of the late 1990s. But it also kept him out of the single most transformative wealth creation event in the history of American capitalism. And the people who did not follow the framework, who bought Amazon at the IPO and held through the crash and the recovery and the second crash and the second recovery, were rewarded with returns that made Berkshire's returns look pedestrian. By comparison, the framework was not wrong. It was incomplete. And the incompleteness was not random. It was systematic. It applied with particular force to a specific category of businesses that were building new technological platforms, and it applied with even more force when those businesses were being offered to the public for the first time. Google is a similar story with a different texture. Buffett has said, publicly and repeatedly, that he understood Google's business model. He used Google's products. Geico, a Berkshire subsidiary, was one of Google's largest advertising customers in the early days of the search advertising market. Buffett could see, with his own eyes and through his own P&L statements, exactly how much value Google was creating for advertisers, and exactly how much of that value Google was capturing for itself. He knew the economics of the business better than almost any outside investor could have known them, and yet he did not buy a single share of Google at its IPO or at any point in the 2 decades that followed. He has said that he simply could not bring himself to pay the valuation that the market was demanding, even though he understood that the business was extraordinary. The framework told him to wait for a better price. The better price never came. Google's IPO price of $85 per share, which many commentators at the time described as absurdly high, now looks like one of the great bargains in stock market history. The stock has appreciated by a factor of roughly 50 since its offering, and every year that Buffett waited for a pullback, the pullback came and went, and the stock ended the year higher than it began. The framework was not designed for businesses where the growth rate exceeds the discount rate for decades at a time. It was designed for businesses where the price eventually reverts to a mean that can be estimated with some confidence. When the mean itself is moving upward at a rate that makes the concept of mean reversion meaningless, the framework breaks. It does not break in a way that produces bad outcomes. It breaks in a way that produces no outcomes at all. The investor who waits for a reasonable price on a business that is growing at 30% a year will wait forever, and the waiting will be the most expensive decision they ever make. Apple is the case that complicates the narrative in the most interesting way, because it is the case where Buffett eventually overcame his blind spot, and the results were spectacular. Berkshire began buying Apple in 2016, roughly 40 years after the company was founded and 36 years after its initial public offering. The purchase was not, by any conventional definition, an IPO investment. The stock had been trading publicly for more than 3 decades. The business model was mature. The growth story of the iPhone had been playing out for nearly a decade. And yet, even at that late stage, Apple was still undervalued by the market in ways that Buffett's framework was uniquely equipped to identify. The brand loyalty was extraordinary. The switching costs were high. The ecosystem was sticky in a way that created a recurring revenue stream from a customer base that was essentially captive. The company was buying back its own shares at a rate that increased the intrinsic value per share for the remaining shareholders. These were all classic Buffett criteria, and they were all present in Apple. And Buffett had missed them for 36 years because he had categorized Apple as a technology company and stopped thinking about it. When he finally applied his framework to the business rather than the category, he recognized that Apple was not, in the economic sense that mattered, a technology company at all. It was a consumer products company with a technology-enabled distribution model, and its moat was as wide as Coca-Cola's, and its customer loyalty was as deep as See's Candies, and its pricing power was as durable as any brand in the Berkshire portfolio. He bought $100 billion worth of the stock over the next several years, and the position is now worth more than $300 billion. And it is the single most profitable investment in the history of Berkshire Hathaway. The lesson is not that Buffett was wrong about technology. The lesson is that Buffett was wrong to exclude an entire category of businesses from consideration because of a label, and that when he finally examined the specific business on its specific merits, his framework worked exactly as it was supposed to. The mistake was the categorical exclusion, not the analytical method. This brings me to SpaceX, and it brings me to the reason that Lawrence Beckwith was sitting in his study on a Tuesday evening, staring at a portrait of the man who had taught him everything, and wondering whether the student was about to surpass the teacher or simply repeat the teacher's oldest mistake. Because SpaceX, when you strip away the rockets and the satellites and the science fiction, looks less like a technology company in the pets.com sense and more like a utility in the Burlington Northern sense. It owns infrastructure that cannot be replicated without spending amounts of money that no rational competitor would spend. It has a cost advantage that widens with every launch, as the data from each recovery feeds back into the engineering process and makes the next recovery more reliable and less expensive. It has a customer base that includes the United States government, the most creditworthy customer on Earth, locked into multi-year contracts that provide a base of revenue that would make most industrial companies envious. It has a satellite internet business that requires launching thousands of satellites into low Earth orbit, which is the kind of barrier to entry that makes the term economic moat feel inadequate. A moat is something you dig around a castle. SpaceX has something closer to a planetary monopoly on a resource that is finite and irreplaceable. The orbital slots and radio frequency spectrum that Starlink uses are allocated by international treaty, and they were allocated to SpaceX because SpaceX was the only entity on Earth capable of using them at the scale required to make the business viable. No competitor can simply decide to build a competing Starlink any more than a competitor could decide to build a competing Panama Canal. The physics of the thing, combined with the regulatory framework and the first mover advantage, create a structural barrier that is arguably wider than any moat in the Berkshire portfolio. Coca-Cola's brand can theoretically be challenged by a competitor with a better marketing campaign. Geico's cost advantage can theoretically be eroded by a competitor with a more efficient claims processing system. Burlington Northern's rail network can theoretically be bypassed by trucks or pipelines, but no one can launch 5,000 satellites into low Earth orbit without owning a reusable rocket, and no one owns a reusable rocket except SpaceX. The rockets are the moat. The rockets are also the bridge to the next moat, and the next moat, the Starlink moat, is being constructed in orbit right now at a pace of roughly 60 satellites per launch and roughly 2 launches per week. And by the time any competitor figures out how to replicate the rocket, the satellites will already be up there. The spectrum will already be occupied. The customers will already be locked in, and the window for competition will have closed. This is not the kind of business that Buffett normally avoids. It is, in its economic essence, the kind of business that Buffett would have spent his entire career trying to find. And yet, if you presented SpaceX to Warren Buffett tomorrow, at the valuation that it is likely to receive in its initial public offering, there is essentially no chance that he would buy it, not because he would fail to recognize the quality of the business, not because he would dispute the width of the moat, not because he would question the competence of the management. He would pass because the price would be too high relative to current earnings, because the future cash flows would be too uncertain to discount with confidence, and because a company that does not yet have a multi-decade track record of profitability in the public markets does not meet the threshold of certainty that his framework requires. He would say, as he has said about many companies before, that he wishes the management well, that he admires what they have built, that he expects the business to be larger and more profitable in 10 years than it is today, but that he cannot bring himself to pay the price that the market is asking. And he would be right, in the narrow sense that his framework defines rightness. The price of SpaceX at the IPO will almost certainly be too high relative to a conservative estimate of normalized earnings 5 years from now. The uncertainty around the Starlink revenue trajectory, the Starship development timeline, the regulatory environment for commercial space, and the competitive response from China and other state-backed actors will be too wide to fit within the confidence interval that a Graham and Dodd-style value investor requires. The company will fail the margin of safety test because the margin of safety cannot be calculated when the range of possible outcomes spans 2 orders of magnitude. So yes, in Buffett's framework, SpaceX is a pass. It is an easy pass. It is the kind of pass that lets you sleep at night and feel superior to the speculators who are chasing returns they do not understand. And it is also, I believe, the same kind of pass that Buffett made on Amazon in 1997, and on Google in 2004, and on Apple before 2016. It is the pass that is technically correct within the limits of the framework and catastrophically expensive in the world outside the framework. The question that Lawrence was grappling with, and the question that I think every serious investor should be grappling with, is whether there is a way to invest in the SpaceX IPO that respects the wisdom of the Buffett framework without being paralyzed by its limitations. Because the two things do not have to be in opposition. You do not have to choose between being a Buffett disciple and buying a technology IPO. You can be a Buffett disciple who occasionally recognizes that the teacher's framework, like all frameworks, has boundary conditions, and that the most important skill in investing is not following any framework blindly, but knowing when the framework applies and when it does not. The SpaceX IPO is a boundary condition. It is the kind of event that the framework was not designed to handle. And if you treat it as if it were a normal IPO, you will make the same mistake that the framework was designed to prevent. But if you refuse to engage with it at all because the framework says no to all IPOs, you will make the same mistake that Buffett made with Amazon and Google and Apple. And the cost of that mistake will compound just as surely as the returns you are avoiding. So what would a Buffett-informed approach to the SpaceX IPO actually look like? Not a Buffett approach, because Buffett himself would not participate, but an approach that takes the principles seriously and applies them with the benefit of hindsight about where Buffett's blind spot has cost him the most. I think there are several components to such an approach, and I want to walk through each of them in detail, because the details are where the difference between thoughtful participation and reckless speculation lives. The first component is position sizing. This is, in my view, the single most important variable in the entire decision, and it is the variable that most IPO investors get wrong. The Buffett framework is built on the idea of concentrating capital in your best ideas, but it is also built on the idea that those best ideas should be businesses whose future cash flows can be estimated with a high degree of confidence. When the confidence is high, the position should be large. When the confidence is low, the position should be small. The SpaceX IPO falls into the low confidence category, not because the business is weak, but because the range of possible outcomes is wide. The correct position size for an investment with a wide range of outcomes is an amount that would be meaningful if the upside case materializes, but not catastrophic if the downside case does. For most individual investors, this means something in the range of 2 to 5% of their total investment portfolio. Not 10%, not 20%, not the mortgage money or the college fund or the retirement account. A slice of the portfolio that, if it went to zero, would be annoying but not life-altering. The slice should be sized so that the investor can hold through a 50% drawdown without being forced to sell, because 50% drawdowns in newly public companies are common, and the people who cannot hold through them are the people who should not be invested in the first place. The second component is timing. The Buffett objection to IPOs is partly about the structural disadvantages that the offering process imposes on buyers, and those disadvantages are real, even for a company as extraordinary as SpaceX. The underwriting banks will allocate the shares primarily to their best institutional clients. The price will be set to leave room for a first-day pop that rewards those clients at the expense of the buyers, who come in after the shares begin trading. The lockup period will expire after 180 days, at which point early employees, venture capital investors, and pre-IPO shareholders who have been waiting for liquidity for years or decades will begin selling their shares, and the selling pressure will almost certainly push the stock price down from whatever level it reached during the post-IPO enthusiasm phase. These dynamics are not unique to SpaceX. They apply to every IPO, and they apply with particular force to IPOs that are as widely anticipated and heavily hyped as SpaceX will be. The Buffett-informed approach to these dynamics is not to refuse to participate at all. It is to participate on your own schedule, rather than the schedule that the underwriting syndicate has designed for you. Wait through the first day, wait through the first week, wait through the first quarter if you can. Let the institutions take their pop and move on to the next deal. Let the insiders sell their shares at the lockup expiration. Let the valuation find a level that reflects the company's actual financial performance, rather than the fever dream of the roadshow. And then, when the excitement has faded and the stock has become boring, and the headlines have moved on to the next shiny object, that is when you buy. If the company is truly as extraordinary as it appears to be, the delay will not cost you the majority of your long-term returns. Compounding is a function of time, but the time that matters is measured in decades, not in months. And the difference between buying on day 1 and buying on day 365 is negligible over a 30-year holding period. What is not negligible is the difference between buying at the peak of post-IPO enthusiasm and buying after the enthusiasm has dissipated, because that difference can be measured in double-digit percentages of your initial capital, and those percentages compound just as surely as the returns themselves. The third component is holding period. This is where the Buffett framework and the SpaceX opportunity align so perfectly that it is almost as if the framework were designed for exactly this kind of investment, even though Buffett himself would not make it. The single biggest advantage that an individual investor has over an institutional investor is the ability to hold for an arbitrarily long period without having to report quarterly results to limited partners or answer to an investment committee or defend a position against redemptions. An institution that buys SpaceX at the IPO and watches the stock decline by 30% over the subsequent 6 months may be forced to sell because its risk management parameters require it, because its investors are withdrawing capital, or because its performance metrics make the position impossible to justify to a board of directors. An individual investor who buys SpaceX at the IPO and watches the stock decline by 30% over the subsequent 6 months can simply not look at the stock price for a year and go on with their life. The holding period is the edge, and it is an edge that compounds. If you buy SpaceX and hold it for 20 years, the short-term dynamics of the IPO market become a rounding error. The first-day pop, the lockup expiration, the quarterly earnings volatility, the analyst downgrades and upgrades, the macro scares and the sector rotations, all of these become noise in the context of a sufficiently long holding period. The only thing that matters over 20 years is whether the business itself compounds at a rate that exceeds the rate at which you could have compounded your capital elsewhere. If the answer is yes, the timing of your entry matters far less than the duration of your hold. And if you cannot commit to a holding period measured in decades, you should not be buying SpaceX at all, regardless of the price. The fourth component is valuation discipline. And this is the hardest one to maintain because it requires doing something that almost no IPO investor does. It requires constructing your own estimate of what the business is worth and comparing that estimate to the price that the market is offering. And then having the discipline to walk away if the gap between price and value is not sufficient to justify the risk. This sounds obvious, but it is not how most people approach IPOs. Most people approach IPOs by asking whether the company is good and whether the sector is exciting and whether other people are buying it. They do not build a discounted cash flow model. They do not compare the implied valuation to the valuations of comparable public companies. They do not stress test their assumptions against a range of scenarios that include adverse outcomes. They buy the story and they call it analysis. And then they are surprised when the story changes and the stock price changes with it. For SpaceX, a reasonable valuation framework might start with the company's existing revenue streams and their growth trajectories. The launch business, which is the original SpaceX business, generates estimated annual revenue of roughly $4 to $5 billion from government and commercial contracts. This business is growing at a moderate rate, perhaps 10 to 15% annually, as the overall launch market expands and SpaceX continues to capture share from legacy competitors. The launch business alone, at maturity, might be worth something like $50 to $80 billion, depending on your assumptions about margins and growth duration. The Starlink business is the primary growth engine, and it is the part of the valuation that generates the widest range of estimates. At 3 million subscribers and growing, with an average revenue per user that is probably in the neighborhood of $100 per month. Starlink is generating annual recurring revenue of roughly $3.5 to $4 billion. The subscriber base is growing rapidly. The service is not yet available in several of the world's largest markets, and the total addressable market of people without reliable broadband access is measured in the billions. If Starlink captures even a small fraction of that market, the revenue could scale to tens of billions of dollars annually, and the margins on a vertically integrated satellite internet business, once the capital expenditure cycle matures, could be substantial. A reasonable base case valuation for the Starlink business, assuming successful execution over the next 5 to 10 years, might be in the range of $200 to $400 billion. The Starship program and the longer-term ambitions in deep space logistics, lunar infrastructure, and eventual Mars colonization are essentially option value at this stage. They could be worth zero. They could be worth more than the launch and Starlink businesses combined. Prudent valuation practice assigns them a modest probability-weighted value, perhaps 10 to 20% of the base case, and acknowledges that the range of possible outcomes is too wide to be modeled with any precision. Add these pieces together, and you get a total valuation range that is almost absurdly wide, from perhaps $200 billion on the low end to more than $1 trillion on the high end, depending on your assumptions about Starlink's growth rate and terminal market share. The IPO will price somewhere in the middle of that range, and the question you have to answer is whether the price you are paying leaves enough upside relative to your assessment of the likely outcome to compensate you for the uncertainty. If the IPO price is at $350 billion and your base case is $500 billion, you have roughly 40% upside over a multi-year period. That is not a home run. That is a reasonable return on a reasonable investment in a business with above average uncertainty. If the IPO price is at $200 billion and your base case is $700 billion, you have a far more attractive setup. The point is not that you can pick the exact right number. Nobody can. The point is that you have to do the work of constructing your own estimate, so that when the price is announced, you have a framework for evaluating whether the price makes sense. Most IPO investors skip this step. They should not. And the Buffett framework would not let them if they actually applied it. The fifth component, and the one that I think is most underappreciated in discussions of whether to participate in the SpaceX IPO, is the distinction between the business and the stock. This is a Buffett distinction, and it is one of the most useful mental models in all of investing. The business is what the company does. The stock is what you buy. They are related, but they are not the same thing. A wonderful business can be a terrible stock if you pay too much for it. A mediocre business can be a wonderful stock if you pay too little for it. Though this is harder to do, and Buffett himself has said that he prefers to buy wonderful businesses at fair prices than fair businesses at wonderful prices. The SpaceX business, by any honest assessment, is extraordinary. It has achieved things that the entire aerospace establishment said were impossible. It has reduced the cost of accessing space by an order of magnitude, and is on track to reduce it by another order of magnitude when Starship becomes operational. It has built a satellite internet constellation that is generating billions of dollars in revenue and growing faster than almost any subscription business in history. It is run by a founder who has demonstrated, across multiple companies, an almost superhuman ability to identify and solve the hardest technical problems that constrain an industry. The business is extraordinary. The stock is a different question. The stock is the price that the market is asking for a fractional ownership interest in that business, and the price will be set by a process that is designed to maximize the proceeds for the selling shareholders and the underwriting banks. The price will not be set to give you a bargain. The price will be set to clear the market at the highest level that institutional demand will support. The gap between the quality of the business and the attractiveness of the stock is the gap that every investor has to bridge for themselves. And the bridging cannot be done by reading articles or watching videos or asking other people what they think. It has to be done by doing the work. Now let me return to Lawrence Beckwith, because his story is the reason I wrote all of this down, and because his resolution is more interesting than the resolution that most financial narratives would give him. Lawrence did not sell everything and put it all into SpaceX. He did not abandon his principles and become a momentum-chasing speculator. He also did not dismiss the opportunity out of hand and make the same mistake he had made with Amazon and Google and every other generational company that had gone public during his investing lifetime. What he did was something in between, something that honored the Buffett framework while acknowledging its limits, something that I think represents the right way to approach an opportunity like this for someone who has spent their entire life being cautious and is tired of watching from the sidelines. He allocated 3% of his portfolio to the SpaceX IPO. 3% was roughly $60,000, which was a significant amount of money by any ordinary standard, but was not an amount that would change his life if it went to zero. He had spent 30 years accumulating his portfolio through the slow, patient application of the principles that the man in the portrait had taught him. $60,000 was roughly what his portfolio earned in dividends and interest in a typical year. He could afford to lose it. He would not enjoy losing it. He would feel foolish, and he would have to admit to his friends and his son that he had violated his own rules and been punished for it. But he could afford it. The mortgage would still be paid. The retirement would still be funded. The golden retriever would still eat the expensive food that the vet recommended. Life would continue. He did not buy on the first day. He submitted an indication of interest through his brokerage and received an allocation that was roughly 20% of what he had requested, which is to say, he received essentially nothing. The institutional investors absorbed the vast majority of the shares, as they always do, and the stock opened for trading at a price that was roughly 30% above the IPO price. Lawrence watched the first day from his study, the portrait looking down at him, and he felt a familiar mixture of vindication and regret. He had been right about the IPO process. The insiders and the institutions had captured the pop. The retail investors who bought at the open were already underwater. But vindication in this case was not satisfying. It was the vindication of being right about a game that he did not want to play, a game whose rules were designed to exclude him, and the regret was the regret of wanting to participate anyway, and being shut out by a system that did not care how much he had studied, or how long he had waited, or how carefully he had prepared. He waited 6 months. He did not check the stock price every day, but he checked it more often than he would have admitted to anyone. The stock drifted lower in the weeks leading up to the lockup expiration, as the financial media ran story after story about the wave of insider selling that was about to hit. By the time the lockup actually expired and the early employees and the venture capital investors began selling in earnest, the stock was trading roughly 15% below its first week high and roughly 8% above the IPO price. The narrative had shifted. The same analysts who had called SpaceX the most important IPO of the decade were now writing notes about valuation concerns and competitive threats and the unpredictability of the regulatory environment. The same media outlets that had run cover stories about the company that was going to Mars were now running segments about whether the stock was overhyped and whether retail investors had been left holding the bag. The cycle was so predictable that Lawrence could have scripted it in advance. The IPO pop, the media adulation, the gradual drift lower, the lockup selling, the narrative reversal. The investors who bought at the top panicking and selling at the bottom. All of it had happened exactly as Buffett said it would, and Lawrence had watched it happen from the sidelines, his principles vindicated, his capital preserved, and his conviction about the underlying business entirely intact. And then, 6 months after the IPO, with the lockup selling behind him and the stock trading at a level that reflected something other than the offering week frenzy, Lawrence bought his shares. He paid a price that was higher than the IPO price, but lower than the first week high. And he accepted that the difference was the cost of his patience. The cost was not trivial. It was roughly $8,000 relative to what he would have paid if he had been able to buy a full allocation at the IPO price. But $8,000, in the context of a $60,000 position that he intended to hold for 20 years, was a rounding error. It was the price of avoiding the worst of the post-IPO volatility, the price of waiting until the insiders had sold, and the narrative had shifted, and the stock had found a level that reflected the market's sober assessment, rather than its fever dream. It was a Buffett-style entry into a non-Buffett-style investment, and it felt, to Lawrence, like the right balance. He had not abandoned his principles. He had adapted them to a situation that the principles had not been designed to address. He wrote his plan on a single sheet of paper and taped it to the wall next to the portrait. The plan said that he would not sell a single share for 10 years, regardless of price. After 10 years, he would reevaluate the business and decide whether the original thesis was still intact. If the thesis was intact and the stock had compounded at a rate that justified the risk he had taken, he would hold for another 10 years. If the thesis had broken, he would sell immediately, regardless of the price, and accept the loss as the cost of a bet that did not work out. The plan did not have a price target. It did not have a stop loss. It did not have a profit-taking rule. It had only 2 conditions and an infinite holding period, and the simplicity of it was the most Buffett thing about the entire approach. He was not trading. He was not speculating. He was buying a fractional ownership interest in a business he believed would be dramatically more valuable in 20 years than it was today, and he was committing to hold that interest through whatever volatility the market threw at him in the interim. The portrait was still there, above his desk, next to the Coca-Cola certificate and the shelf of leather-bound annual reports. Lawrence had not taken it down. He had not decided that Buffett was wrong, or that value investing was obsolete, or that the old principles no longer apply. He had simply decided that the principles were a starting point, not an ending point, and that the most important principle, the one that Buffett himself had embodied throughout his career, was the willingness to learn from mistakes, including the mistakes of the people you most admire. Buffett had learned from his mistake with Apple. He had learned that categorically, excluding an entire sector of the economy was not a principle. It was a prejudice, and that the right approach was to evaluate each business on its own merits, regardless of the label that the market had assigned to it. Lawrence was trying to learn the same lesson, and he was trying to learn it in time to apply it to an opportunity that he believed would not come again in his lifetime. He closed his laptop and looked up at the portrait. The man in the portrait looked back at him with that expression that was half grandfather and half predator, the expression that had made him the most successful investor in history. Lawrence imagined what Buffett would say if he could see him now, a 58-year-old value investor sitting in a study in suburban Connecticut, having just bought shares in a rocket company at a valuation that could not be justified by any conventional metric. He imagined Buffett would smile that sideways smile and say something about how he had made his own mistakes and learned from them, and that Lawrence was entitled to make his own mistakes and learn from them too. And then he imagined Buffett would ask him whether he had done the work, whether he had read the S1, whether he had run the numbers, whether he had tested his assumptions against a range of adverse scenarios, whether he had sized the position so that a permanent loss of capital would not permanently impair his standard of living. And Lawrence would be able to say, honestly, that he had. He had not bought the story. He had bought the business at a price he could live with, in a size he could afford to lose, with a holding period that would give the compounding time to work. He had done everything that the man in the portrait had taught him to do, except for the part about never buying initial public offerings. And that part, he had come to believe, was not a principle. It was a heuristic. It was a rule of thumb that had served Buffett well for 60 years. But that did not, and could not, apply to every situation in every market for every investor, for all time. The principle underneath the heuristic was the important thing. The principle was to never buy something you did not understand, at a price you could not justify with a holding period you could not maintain. And that principle, Lawrence had followed. He reached up and straightened the portrait, which had tilted slightly during the summer, when the humidity had warped the frame. He looked at the face of the man who had taught him everything he knew about money, about patience, about the long arc of compounding, about the difference between price and value, and the importance of knowing which one you were paying. He thought about the $60,000 that was now sitting in shares of a company that had not existed when he had bought his first share of Berkshire Hathaway in 1991. He thought about his son, who had called him the night before to ask about the SpaceX allocation and who had listened carefully while Lawrence explained the framework, the sizing, the timing, the holding period, the plan. His son had asked him if he was nervous, and Lawrence had said that he was, but that nervousness was not the same thing as fear, and that the difference between the two was the plan. The plan was what allowed you to be nervous without being reckless. The plan was what allowed you to take a risk that your principles said you should not take, while still following the spirit of those principles. The plan was the bridge between the framework and the opportunity, and the bridge was sound. He turned off the light in the study and walked downstairs to the kitchen, where his wife was making dinner, and the golden retriever was lying on the floor in the exact center of the room, as if the room had been designed around the dog. She asked him how the SpaceX thing had gone, and he said fine, and she said that did not sound very exciting for something he had been thinking about for 6 months. And he said that the right kind of investing was not supposed to be exciting. The excitement was in the outcome, not the process. The process was supposed to be boring. The process was supposed to be methodical. The process was supposed to be the kind of thing that you could explain to your son in 20 minutes and then not think about for a year. He had done the process. He had made the decision. The shares were in his account, and now he was going to eat dinner and walk the dog and go to sleep and not think about the stock price until he had a reason to think about it. That was the plan. That was the principle. And whatever happened next, whether the stock doubled or halved or did nothing for a decade, he would know that he had approached the decision the way the man in the portrait had taught him to approach every decision. Not by following a rule book, but by thinking. Not by asking what someone else would do, but by doing the work and reaching his own conclusion. The greatest compliment you could pay Warren Buffett was not to imitate him. It was to think as independently as he did, even when independence meant disagreeing with him. And Lawrence Beckwith, sitting at his kitchen table with his wife and his dog and his plan taped to the wall upstairs, had finally done that.